Question 1. A policyholder in Oregon is considering purchasing a permanent life insurance policy. Which of the following statements accurately describes a feature of permanent life insurance policies? A. Premiums remain level throughout the life of the policy. B. Cash value accumulation is not a feature of permanent life insurance. C. Policyholders can change the death benefit amount after the policy is issued. D. Surrender charges are typically not applicable if the policy is terminated early. The correct answer, A. Premiums remain level throughout the life of the policy. Explanation. In Oregon, as in most states, permanent life insurance policies offer level premiums, meaning the premium payments remain constant throughout the life of the policy. This stability provides policyholders with predictability and ease of budgeting. Additionally, permanent life insurance policies usually feature a cash value component that accumulates over time, providing a savings or investment aspect. Policyholders can access this cash value through policy loans or withdrawals, providing a degree of flexibility and financial security. It's important to note that changes to the death benefit amount may require underwriting approval, and surrender charges often apply if the policy is terminated early, although these charges may decrease over time. Question 2. Mrs. Garcia, a resident of Oregon, is considering purchasing a life insurance policy to provide financial protection for her family. She's interested in a term life insurance policy. What is a characteristic of term life insurance that Mrs. Garcia should be aware of? A. Term life insurance policies accumulate cash value over time. B. Premiums for term life insurance policies tend to increase as the insured ages. C. Term life insurance policies provide coverage for the insured's entire life. D. Term life insurance policies offer flexible payment schedules. The correct answer, B. Premiums for term life insurance policies tend to increase as the insured ages. Explanation. In Oregon, term life insurance policies typically offer coverage for a specified period, such as 10, 20, or 30 years. One characteristic of term life insurance is that premiums often increase as the insured ages, especially upon policy renewal. This increase reflects the higher risk associated with insuring individuals at older ages. Unlike permanent life insurance policies, term life insurance does not accumulate cash value over time. Term life insurance provides coverage for a set term and does not offer lifelong protection. It's essential for Mrs. Garcia to understand that while term life insurance can provide affordable coverage for a specific period, premiums may become more expensive upon renewal, especially if she chooses to renew at an older age. Question 3. Mr. Thompson, a resident of Oregon, is interested in purchasing a life insurance policy but is unsure whether to choose term or permanent coverage. Which of the following statements accurately compares term and permanent life insurance policies? A. Term life insurance policies offer coverage for a specified term, while permanent life insurance policies provide coverage for the insured's entire life. B. Permanent life insurance policies typically have lower initial premiums compared to term life insurance policies. C. Term life insurance policies allow policyholders to build cash value over time. D. Permanent life insurance policies do not require a medical exam for approval. The correct answer, A. Term life insurance policies offer coverage for a specified term, while permanent life insurance policies provide coverage for the insured's entire life. Explanation. In Oregon, as in most states, term life insurance policies offer coverage for a specific term, such as 10, 20, or 30 years, while permanent life insurance policies provide coverage for the insured's entire life. Term life insurance policies typically have lower initial premiums compared to permanent life insurance policies, making them an attractive option for individuals seeking affordable coverage for a specific period. However, unlike permanent life insurance, term policies do not accumulate cash value over time. Additionally, permanent life insurance policies often require a medical exam for approval, as they involve a longer-term commitment and may include cash value accumulation and other features. It's important for Mr. Thompson to carefully consider his needs and financial goals when choosing between term and permanent life insurance policies. Question 4. Ms. Ramirez is considering purchasing a life insurance policy in Oregon to protect her family's financial future. She's heard about whole life insurance and universal life insurance but is unsure about the differences. Which of the following statements correctly distinguishes between whole life and universal life insurance policies? A. Whole life insurance policies offer flexible premium payments, while universal life insurance policies have fixed premiums. B. Universal life insurance policies provide a guaranteed death benefit, while whole life insurance policies do not guarantee the death benefit. C. Whole life insurance policies typically offer more investment options than universal life insurance policies. D. Universal life insurance policies have a fixed duration, while whole life insurance policies provide coverage for the insured's entire life. The correct answer, B. Universal life insurance policies provide a guaranteed death benefit, while whole life insurance policies do not guarantee the death benefit. Explanation. In Oregon, whole life insurance policies and universal life insurance policies differ primarily in their flexibility and guarantees. While whole life insurance policies typically offer fixed premiums and a guaranteed death benefit, universal life insurance policies often provide flexibility in premium payments and death benefit amounts. However, universal life insurance policies do provide a guaranteed minimum death benefit, which ensures that beneficiaries receive a certain payout regardless of policy performance. Whole life insurance policies, on the other hand, do not guarantee the death benefit, as it may vary based on policy dividends and other factors. It's important for Ms. Ramirez to understand these distinctions and consider her financial needs and preferences when choosing between whole life and universal life insurance policies. Question 5. Mr. Evans, a resident of Oregon, is interested in purchasing a life insurance policy to provide financial protection for his family. He's considering adding riders to his policy for additional coverage. Which of the following statements accurately describes a common rider that Mr. Evans might consider adding to his life insurance policy? A. Accelerated death benefit rider. B. Investment rider. C. Waiver of premium rider. D. Policy loan rider. The correct answer, A. Accelerated death benefit rider. Explanation. In Oregon, an accelerated death benefit rider is a common rider that policyholders may consider adding to their life insurance policy. This rider allows the policyholder to receive a portion of the death benefit early if they are diagnosed with a qualifying terminal illness or chronic condition. The accelerated death benefit can help policyholders cover medical expenses or other financial needs during a challenging time. Other common riders include the waiver of premium rider, which waives premium payments if the insured becomes disabled, and policy loan riders, which allow policyholders to borrow against the cash value of their policy. Investment riders, while available in some insurance products, are not typically associated with traditional life insurance policies. Question 6. Mrs. Anderson, a resident of Oregon, wants to ensure that her life insurance policy provides protection against inflation. Which type of life insurance policy would best address Mrs. Anderson's concern? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Indexed universal life insurance. The correct answer, D. Indexed universal life insurance. Explanation. In Oregon, indexed universal life insurance is a type of permanent life insurance policy that offers a death benefit along with a cash value component that can accumulate over time. One of the advantages of indexed universal life insurance is that it typically offers a cash value accumulation that is tied to the performance of an underlying market index, such as the S&P 500. This indexing feature can help policyholders potentially earn higher returns, which may provide some protection against inflation over the long term. Additionally, indexed universal life insurance policies often offer flexibility in premium payments and death benefit amounts, allowing policyholders to adjust their coverage as needed. This type of policy may be suitable for Mrs. Anderson's needs if she is concerned about protecting her life insurance coverage against the impact of inflation. Question 7. Mr. Patel, a resident of Oregon, is considering purchasing a life insurance policy to protect his family financially. He's curious about the difference between participating and non-participating policies. Which of the following accurately describes a feature of participating life insurance policies? A. Policyholders of participating life insurance policies are not eligible to receive dividends. B. Participating life insurance policies offer fixed premiums for the life of the policy. C. Policyholders of participating life insurance policies have the potential to receive dividends from the insurance company. D. Participating life insurance policies do not provide a death benefit to beneficiaries. The correct answer, C. Policyholders of participating life insurance policies have the potential to receive dividends from the insurance company. Explanation. In Oregon, participating life insurance policies allow policyholders to share in the profits of the insurance company in the form of dividends. These dividends are not guaranteed but are typically distributed when the insurance company's financial performance exceeds expectations. Policyholders can choose how to use these dividends, such as receiving them in cash, using them to reduce premiums, purchasing additional coverage, or accumulating them with interest. Non-participating policies, on the other hand, do not provide the opportunity for policyholders to receive dividends. It's important for Mr. Patel to understand this distinction and consider his preferences when selecting a life insurance policy. Question 8. Mrs. Lee is interested in purchasing a life insurance policy in Oregon but is concerned about the impact of inflation on her coverage amount. Which of the following features of a life insurance policy could help address Mrs. Lee's concern? A. Convertibility. B. Cash surrender value. C. Guaranteed insurability option. D. Increasing death benefit option. The correct answer, D. Increasing death benefit option. Explanation. In Oregon, an increasing death benefit option is a feature available in some life insurance policies that allows policyholders to periodically increase their death benefit coverage without undergoing additional underwriting. This option helps address concerns about inflation by ensuring that the policy's coverage amount keeps pace with changes in the cost of living over time. Policyholders may choose to exercise this option at specific intervals, such as annually or every few years, to adjust their coverage according to their evolving needs. By selecting the increasing death benefit option, Mrs. Lee can help ensure that her life insurance coverage maintains its effectiveness in providing financial protection for her beneficiaries despite the impact of inflation. Question 9. Mr. Nguyen is considering purchasing a life insurance policy in Oregon and wants to ensure that his beneficiaries receive the death benefit without delay. Which of the following factors could potentially affect the timely payment of the death benefit to Mr. Nguyen's beneficiaries? A. The insured's occupation. B. The age of the insured. C. The policy's suicide clause. D. The beneficiary's relationship to the insured. The correct answer, C. The policy's suicide clause. Explanation. In Oregon, as in many states, life insurance policies typically include a suicide clause, which specifies that the death benefit will not be paid if the insured dies by suicide within a certain period after the policy's inception, usually within the first 1 or 2 years. If the insured's death is determined to be a suicide within this time frame, the insurance company may refund the premiums paid instead of paying the death benefit. While factors such as the insured's occupation, age, and beneficiary's relationship to the insured can impact the underwriting process and premium determination, they generally do not affect the timely payment of the death benefit if the policy is in force at the time of the insured's death. It's important for Mr. Nguyen to be aware of the suicide clause and its implications when purchasing a life insurance policy. Question 10. Mr. Williams, a resident of Oregon, is considering purchasing a term life insurance policy to provide financial protection for his family. Which of the following statements accurately describes a characteristic of term life insurance policies? A. Term life insurance policies offer coverage for the insured's entire life. B. Premiums for term life insurance policies tend to decrease as the insured ages. C. Term life insurance policies typically accumulate cash value over time. D. Policyholders can adjust the death benefit amount after the policy is issued. The correct answer, D. Policyholders can adjust the death benefit amount after the policy is issued. Explanation. In Oregon, term life insurance policies offer coverage for a specified term, such as 10, 20, or 30 years. One of the features of term life insurance is the flexibility it provides in adjusting the death benefit amount after the policy is issued. Policyholders may choose to increase or decrease the death benefit to align with their changing needs, such as changes in income, family size, or financial obligations. Unlike permanent life insurance policies, term policies do not accumulate cash value over time. Additionally, premiums for term life insurance policies tend to increase rather than decrease as the insured ages, reflecting the increased risk of mortality associated with advancing age. Question 11. Mrs. Jackson is comparing different types of life insurance policies in Oregon and is interested in term life insurance. Which of the following factors should Mrs. Jackson consider when selecting a term life insurance policy? A. Cash value accumulation. B. Conversion options. C. Investment returns. D. Premium payment frequency. The correct answer, B. Conversion options. Explanation. When selecting a term life insurance policy in Oregon, Mrs. Jackson should consider conversion options as an essential factor. Conversion options allow policyholders to convert their term life insurance policy into a permanent life insurance policy without undergoing additional medical underwriting. This feature provides flexibility for policyholders who may wish to convert to permanent coverage later in life, such as when their financial situation or insurance needs change. Cash value accumulation and investment returns are features typically associated with permanent life insurance policies rather than term life insurance. Premium payment frequency refers to how often premiums are paid and may vary depending on the insurer's payment options but is not specific to term life insurance policies. Question 12. Mr. Rodriguez is interested in purchasing a term life insurance policy in Oregon but is unsure about the renewal provisions. Which of the following accurately describes how renewal provisions typically work in term life insurance policies? A. Term life insurance policies renew automatically without requiring underwriting. B. Renewal premiums for term life insurance policies are fixed for the duration of the policy. C. Policyholders must undergo medical underwriting to renew a term life insurance policy. D. Renewal provisions allow policyholders to renew their coverage for an additional term without providing proof of insurability. The correct answer, D. Renewal provisions allow policyholders to renew their coverage for an additional term without providing proof of insurability. Explanation. In Oregon, term life insurance policies often include renewal provisions that allow policyholders to renew their coverage for an additional term without undergoing additional medical underwriting or providing proof of insurability. This feature provides policyholders with the option to continue their coverage beyond the initial term without the risk of being denied renewal due to changes in health or other factors. Renewal premiums for term life insurance policies may increase upon renewal, reflecting the insured's increased age and potentially higher risk of mortality. However, renewal provisions ensure that policyholders have the opportunity to maintain their coverage even if their health status changes during the initial term of the policy. Question 13. Ms. Taylor is considering purchasing a term life insurance policy in Oregon but wants to understand the difference between renewable and convertible term policies. Which of the following statements accurately distinguishes between renewable and convertible term life insurance policies? A. Renewable term policies allow policyholders to convert their policy to a permanent life insurance policy without additional underwriting. B. Convertible term policies allow policyholders to renew their coverage for an additional term without providing proof of insurability. C. Renewable term policies guarantee the same premium rate for the duration of the policy term. D. Convertible term policies guarantee a death benefit payout regardless of the insured's age at the time of death. The correct answer, A. Renewable term policies allow policyholders to convert their policy to a permanent life insurance policy without additional underwriting. Explanation. In Oregon, Renewable term life insurance policies allow policyholders to renew their coverage for an additional term without providing proof of insurability. However, convertible term policies offer an additional feature that allows policyholders to convert their term policy into a permanent life insurance policy without undergoing additional medical underwriting. This conversion option provides flexibility for policyholders who may wish to transition to permanent coverage later in life, regardless of changes in their health. Renewable term policies typically do not guarantee the same premium rate for the duration of the policy term, as renewal premiums may increase based on the insured's age at the time of renewal. Additionally, the guarantee of a death benefit payout is a standard feature of both renewable and convertible term policies. Question 14. Mr. Smith is comparing term life insurance policies in Oregon and is interested in understanding the role of underwriting in the application process. Which of the following accurately describes the role of underwriting in the issuance of term life insurance policies? A. Underwriting determines the premium payment frequency for term life insurance policies. B. Underwriting evaluates the financial performance of the insurance company offering term life insurance policies. C. Underwriting assesses the risk associated with insuring the applicant and determines the premium rate. D. Underwriting determines the coverage amount for term life insurance policies based on the applicant's health status. The correct answer, C. Underwriting assesses the risk associated with insuring the applicant and determines the premium rate. Explanation. In Oregon, underwriting plays a crucial role in the issuance of term life insurance policies by assessing the risk associated with insuring the applicant. Underwriters evaluate factors such as the applicant's age, health status, lifestyle habits, and medical history to determine the level of risk the applicant presents to the insurance company. Based on this assessment, underwriters determine the premium rate that the applicant will pay for coverage. The premium payment frequency, financial performance of the insurance company, and coverage amount are also important considerations in the life insurance application process, but they are not directly determined by underwriting. Question 15. Mrs. Martinez is considering purchasing a term life insurance policy in Oregon to provide financial protection for her family. She wants to ensure that her coverage includes a level death benefit throughout the policy term. Which type of term life insurance policy should Mrs. Martinez choose? A. Increasing term life insurance. B. Decreasing term life insurance. C. Renewable term life insurance. D. Level term life insurance. The correct answer, D. Level term life insurance. Explanation. In Oregon, level term life insurance is a type of term policy that provides a level death benefit throughout the policy term. This means that the death benefit remains the same from the start of the policy until its expiration, providing consistent coverage for the insured's beneficiaries. Level term life insurance policies are popular among individuals seeking predictable and stable coverage for a specific period, such as 10, 20, or 30 years. Unlike increasing term life insurance, which features a death benefit that increases over time, or decreasing term life insurance, which features a death benefit that decreases over time, level term life insurance maintains a constant death benefit amount for the duration of the policy term. This type of policy can offer peace of mind to policyholders by ensuring that their beneficiaries receive a consistent level of financial protection. Question 16. Mr. Johnson, a resident of Oregon, is interested in purchasing a term life insurance policy but is concerned about the potential for his premiums to increase over time. Which type of term life insurance policy would address Mr. Johnson's concern? A. Renewable term life insurance. B. Level term life insurance. C. Decreasing term life insurance. D. Convertible term life insurance. The correct answer, B. Level term life insurance. Explanation. In Oregon, level term life insurance provides a fixed premium and a level death benefit throughout the policy term. With level term insurance, Mr. Johnson can rest assured that his premiums will remain consistent for the duration of the policy, offering financial predictability and stability. This type of policy is suitable for individuals who want to lock in a stable premium for a specified period, such as 10, 20, or 30 years, without worrying about fluctuations in premium costs over time. Question 17. Ms. Nguyen is comparing different term life insurance policies in Oregon and wants to ensure that her policy offers flexibility for the future. Which feature of term life insurance policies provides flexibility for policyholders to convert their coverage to permanent insurance? A. Conversion option. B. Renewable provision. C. Accelerated death benefit rider. D. Waiver of premium rider. The correct answer, A. Conversion option. Explanation. In Oregon, a conversion option is a feature of term life insurance policies that allows policyholders to convert their term coverage into a permanent life insurance policy without the need for additional underwriting or evidence of insurability. This feature provides flexibility for policyholders who may want to extend their coverage beyond the initial term or transition to permanent insurance later in life. While renewable provisions allow policyholders to renew their term coverage for an additional term, they do not provide the option to convert to permanent insurance. Accelerated death benefit riders and waiver of premium riders are additional policy features that provide benefits related to the death benefit and premium payments, respectively, but they do not offer conversion flexibility. Question 18. Mrs. Thompson is comparing the premiums for different term life insurance policies in Oregon and notices that some policies offer lower initial premiums than others. What feature of term life insurance policies might explain the difference in premiums? A. Convertibility. B. Renewable provision. C. Coverage amount. D. Length of the term. The correct answer, D. Length of the term. Explanation. In Oregon, the length of the term is a significant factor influencing the premium cost of term life insurance policies. Policies with longer terms, such as 30 years, often have higher initial premiums compared to policies with shorter terms, such as 10 or 20 years. This is because longer-term policies provide coverage for a more extended period, resulting in a higher likelihood that the insurance company will pay out a death benefit during the policy term. Additionally, policies with higher coverage amounts typically have higher premiums, as the insurance company is taking on a greater risk by providing a larger death benefit. While convertibility, renewable provisions, and coverage amounts may affect premiums, the length of the term is the primary factor driving differences in premium costs among term life insurance policies. Question 19. Mr. Thompson, a resident of Oregon, is considering purchasing a variable life insurance policy to provide financial protection for his family. Which of the following statements accurately describes a feature of variable life insurance policies? A. Premiums for variable life insurance policies are fixed and do not change over time. B. Variable life insurance policies offer a guaranteed minimum death benefit regardless of investment performance. C. Policyholders have no control over the investment options within a variable life insurance policy. D. Cash value accumulation in variable life insurance policies is not subject to market fluctuations. The correct answer, B. Variable life insurance policies offer a guaranteed minimum death benefit regardless of investment performance. Explanation. In Oregon, variable life insurance policies offer a combination of life insurance protection and investment opportunities. One of the distinguishing features of variable life insurance policies is that they offer a guaranteed minimum death benefit, regardless of the performance of the underlying investments. This means that even if the investments within the policy perform poorly, the beneficiary will receive at least the guaranteed minimum death benefit amount. Variable life insurance policies allow policyholders to allocate their premium payments among various investment options, such as mutual funds, stocks, and bonds, offering the potential for cash value growth over time. However, because the cash value is invested in the market, it is subject to fluctuations based on the performance of the selected investments. Question 20. Ms. Rodriguez is interested in purchasing a variable life insurance policy in Oregon and wants to understand the role of the Securities and Exchange Commission, SEC, in regulating variable life insurance policies. Which of the following accurately describes the SEC's role in regulating variable life insurance policies? A. The SEC regulates the marketing and advertising of variable life insurance policies to ensure transparency and consumer protection. B. The SEC oversees the payment of death benefits to beneficiaries under variable life insurance policies. C. The SEC determines the premium rates for variable life insurance policies based on actuarial principles. D. The SEC approves the investment options available within variable life insurance policies to ensure they meet certain standards. The correct answer, A. The SEC regulates the marketing and advertising of variable life insurance policies to ensure transparency and consumer protection. Explanation. In Oregon, as in other states, the Securities and Exchange Commission, SEC, plays a regulatory role in overseeing the marketing and advertising of variable life insurance policies. The SEC aims to ensure that consumers receive clear and accurate information about the features, risks, and costs associated with variable life insurance products. This regulation helps protect consumers from deceptive or misleading sales practices and ensures transparency in the marketing of variable life insurance policies. While insurance regulators at the state level oversee other aspects of variable life insurance, such as licensing, solvency, and policy provisions, the SEC focuses specifically on the securities aspects of variable life insurance products. Question 21. Mrs. Lee is considering purchasing a variable life insurance policy in Oregon and wants to know how the cash value component of the policy is taxed. Which of the following statements accurately describes the tax treatment of cash value in variable life insurance policies? A. Withdrawals from the cash value of variable life insurance policies are always tax-free. B. Loans from the cash value of variable life insurance policies are taxable as ordinary income. C. Surrendering a variable life insurance policy results in capital gains tax on the cash value accumulation. D. Death benefits from variable life insurance policies are subject to estate tax. The correct answer, B. Loans from the cash value of variable life insurance policies are taxable as ordinary income. Explanation. In Oregon, withdrawals from the cash value of variable life insurance policies are not always tax-free. While policyholders can typically access the cash value through withdrawals or loans, any withdrawals or loans are considered loans against the policy's cash value and are subject to taxation as ordinary income to the extent that they exceed the policyholder's basis in the policy. The basis generally includes the total premiums paid into the policy minus any previous withdrawals or loans. Policyholders may also face penalties for withdrawals or loans taken before age 59.5. Surrendering a variable life insurance policy may result in taxable income to the extent that the surrender value exceeds the policyholder's basis in the policy. Additionally, death benefits from variable life insurance policies are generally received income tax-free by the beneficiaries, although they may be subject to estate tax if the policyholder's estate exceeds certain thresholds. Question 22. Mr. Garcia is interested in purchasing a variable life insurance policy in Oregon and wants to understand the concept of separate accounts within these policies. Which of the following statements accurately describes separate accounts in variable life insurance policies? A. Separate accounts in variable life insurance policies are managed by insurance agents to ensure policyholders receive a guaranteed return on investment. B. Separate accounts are established by insurance companies to pool premiums and pay out death benefits to beneficiaries. C. Policyholders have control over the investment options within separate accounts and bear the investment risk. D. Separate accounts are regulated by state insurance departments to ensure compliance with investment guidelines. The correct answer, C. Policyholders have control over the investment options within separate accounts and bear the investment risk. Explanation. In Oregon, separate accounts within variable life insurance policies are established by insurance companies to hold the assets of the policyholders. Policyholders have control over the investment options within these separate accounts and can allocate their premiums among various investment options, such as stocks, bonds, and mutual funds. Unlike traditional whole life insurance policies where the insurance company bears the investment risk, with variable life insurance policies, policyholders bear the investment risk and the potential for investment gains or losses. The performance of the investments within the separate accounts directly impacts the cash value accumulation and ultimately the death benefit of the policy. Question 23. Mrs. Patel is considering purchasing a variable life insurance policy in Oregon and wants to understand how the cash value component of the policy can be accessed. Which of the following options is available for policyholders to access the cash value in a variable life insurance policy? A. Surrendering the policy. B. Withdrawing dividends. C. Selling the policy on the secondary market. D. Borrowing against the policy's cash value. The correct answer, D. Borrowing against the policy's cash value. Explanation. In Oregon, policyholders of variable life insurance policies have the option to access the cash value of their policy by borrowing against it. Policy loans allow policyholders to borrow funds from the accumulated cash value of the policy while keeping the policy in force. Policy loans typically accrue interest, and any outstanding loan balance reduces the death benefit payable to beneficiaries. Policyholders have flexibility in repaying the loan, and if not repaid, the outstanding loan balance and accrued interest are deducted from the death benefit when the insured passes away. Surrendering the policy is another option to access the cash value, but it involves terminating the policy and may result in surrender charges and taxes. Withdrawing dividends and selling the policy on the secondary market are not typically available options for accessing the cash value of a variable life insurance policy. Question 24. Mr. Anderson is considering purchasing a variable life insurance policy in Oregon and wants to know how the death benefit is determined. Which of the following accurately describes how the death benefit is determined in a variable life insurance policy? A. The death benefit is fixed and guaranteed at the time the policy is issued. B. The death benefit is determined based on the cash value accumulation within the policy. C. The death benefit fluctuates based on the performance of the investments within the policy's separate accounts. D. The death benefit is determined by the policyholder's age and health status at the time of death. The correct answer, C. The death benefit fluctuates based on the performance of the investments within the policy's separate accounts. Explanation. In Oregon, the death benefit in a variable life insurance policy is not fixed and guaranteed at the time the policy is issued. Instead, it fluctuates based on the performance of the investments within the policy's separate accounts. As the policyholder allocates premiums among various investment options and the investments within the separate accounts experience gains or losses, the cash value accumulation and ultimately the death benefit of the policy fluctuate accordingly. Policyholders bear the investment risk, and the death benefit is not guaranteed to remain constant throughout the life of the policy. This feature distinguishes variable life insurance from traditional whole life insurance policies, where the death benefit is fixed and guaranteed at the time of issuance. Question 25. Ms. Campbell is considering purchasing a variable life insurance policy in Oregon and wants to understand the role of the insurance company in managing the investments within the policy's separate accounts. Which of the following statements accurately describes the insurance company's role in managing investments in variable life insurance policies? A. The insurance company guarantees a minimum rate of return on investments within the policy's separate accounts. B. Policyholders have full discretion in selecting and managing investments within the policy's separate accounts. C. The insurance company acts as a fiduciary and makes investment decisions on behalf of the policyholders. D. The insurance company provides a list of pre-approved investment options, and policyholders choose from those options. The correct answer, D. The insurance company provides a list of pre-approved investment options, and policyholders choose from those options. Explanation. In Oregon, insurance companies offering variable life insurance policies typically provide policyholders with a list of pre-approved investment options for the policy's separate accounts. Policyholders have the flexibility to choose from these investment options based on their risk tolerance, investment objectives, and financial goals. The insurance company does not guarantee a minimum rate of return on investments within the separate accounts, and policyholders bear the investment risk. While the insurance company may provide information and support related to the investment options, policyholders ultimately make the investment decisions. Question 26. Mr. Davis is interested in purchasing a variable life insurance policy in Oregon but wants to know how the death benefit is taxed. Which of the following statements accurately describes the tax treatment of the death benefit in variable life insurance policies? A. The death benefit is subject to income tax for the beneficiaries. B. The death benefit is exempt from federal income tax but may be subject to estate tax. C. The death benefit is taxed at the same rate as capital gains. D. The tax treatment of the death benefit depends on the policyholder's age at the time of death. The correct answer, B. The death benefit is exempt from federal income tax but may be subject to estate tax. Explanation. In Oregon, the death benefit received by beneficiaries from a variable life insurance policy is generally exempt from federal income tax under current tax law. However, the death benefit may be included in the policyholder's estate for federal estate tax purposes if the policyholder is the owner of the policy at the time of death. Estate tax rules and exemptions may apply depending on the total value of the policyholder's estate. It's important for policyholders to consult with a tax advisor to understand the tax implications of their variable life insurance policy based on their individual circumstances. Question 27. Mrs. Foster is comparing variable life insurance policies in Oregon and wants to know how the policy's cash value affects the death benefit. Which of the following accurately describes the relationship between the cash value and death benefit in variable life insurance policies? A. The death benefit decreases as the cash value accumulates within the policy. B. The death benefit increases proportionally with the cash value accumulation over time. C. The death benefit remains fixed regardless of changes in the cash value. D. The death benefit is equal to the cash value at the time of the insured's death. The correct answer, B. The death benefit increases proportionally with the cash value accumulation over time. Explanation. In Oregon, the death benefit in a variable life insurance policy is typically linked to the cash value accumulation within the policy. As the cash value accumulates over time through premium payments and investment returns, the death benefit increases proportionally. This feature allows policyholders to potentially enhance the death benefit over the life of the policy by contributing to the cash value and achieving investment growth. The death benefit is not fixed and can vary based on changes in the cash value, providing flexibility and potential for increased financial protection for beneficiaries. Question 28. Mr. Smith is considering purchasing a final expense insurance policy in Oregon to cover funeral and burial expenses. Which of the following statements accurately describes a characteristic of final expense insurance policies? A. Final expense insurance policies require a medical exam for approval. B. Final expense insurance policies typically offer high coverage amounts. C. Final expense insurance policies are permanent life insurance policies. D. Final expense insurance policies have accelerated death benefits. The correct answer, D. Final expense insurance policies have accelerated death benefits. Explanation. In Oregon, final expense insurance policies are designed to cover funeral and burial expenses, as well as other end-of-life costs. One of the features of final expense insurance policies is accelerated death benefits. This means that policyholders may be eligible to receive a portion of the death benefit early if they are diagnosed with a terminal illness or require long-term care. Accelerated death benefits can help policyholders cover medical expenses and other costs associated with end-of-life care. Final expense insurance policies typically do not require a medical exam for approval, making them more accessible for individuals with health concerns. Additionally, final expense insurance policies often provide lower coverage amounts compared to traditional life insurance policies, as they are intended to cover specific expenses rather than provide comprehensive financial protection. Question 29. Mrs. Johnson is interested in purchasing a final expense insurance policy in Oregon and wants to know if the death benefit is taxable. Which of the following accurately describes the tax treatment of the death benefit in final expense insurance policies? A. The death benefit is exempt from federal income tax. B. The death benefit is subject to federal income tax for beneficiaries. C. The death benefit is partially taxable based on the policy's cash value accumulation. D. The tax treatment of the death benefit depends on the beneficiary's relationship to the insured. The correct answer, A. The death benefit is exempt from federal income tax. Explanation. In Oregon, the death benefit received by beneficiaries from a final expense insurance policy is generally exempt from federal income tax under current tax law. Unlike other forms of income, such as wages or investment gains, the death benefit is considered a tax-free distribution from the life insurance policy. This tax advantage helps ensure that beneficiaries receive the full value of the death benefit to cover funeral and burial expenses without the burden of taxation. While the death benefit is exempt from federal income tax, it may be included in the insured's estate for estate tax purposes if the insured is the owner of the policy at the time of death. Estate tax rules and exemptions may apply depending on the total value of the insured's estate. Question 30. Mr. Brown is comparing final expense insurance policies in Oregon and wants to know if the premiums are fixed or adjustable. Which of the following accurately describes the premium structure of final expense insurance policies? A. Premiums for final expense insurance policies are fixed and do not change over time. B. Premiums for final expense insurance policies increase annually based on the insured's age. C. Premiums for final expense insurance policies are determined based on the insured's health status. D. Premiums for final expense insurance policies are adjusted periodically based on changes in the cost of living. The correct answer, A. Premiums for final expense insurance policies are fixed and do not change over time. Explanation. In Oregon, final expense insurance policies often feature fixed premiums, meaning that the premium amount remains consistent and does not change over time. This allows policyholders to budget for the cost of coverage without worrying about annual premium increases based on factors such as age or health status. Fixed premiums provide stability and predictability for policyholders, particularly for individuals on fixed incomes or those looking for affordable coverage options. While other types of life insurance policies may offer adjustable premiums or premium increases over time, final expense insurance policies are specifically designed to provide simple, straightforward coverage for end-of-life expenses with fixed premium payments. Question 31. Ms. Rodriguez is considering purchasing a final expense insurance policy in Oregon and wants to understand the differences between term life insurance and final expense insurance. Which of the following statements accurately describes a key difference between term life insurance and final expense insurance? A. Term life insurance provides coverage for a specified period, while final expense insurance provides coverage for end-of-life expenses only. B. Term life insurance requires a medical exam for approval, while final expense insurance typically does not. C. Term life insurance offers adjustable premiums, while final expense insurance offers fixed premiums. D. Term life insurance policies have accelerated death benefits, while final expense insurance policies do not. The correct answer, A. Term life insurance provides coverage for a specified period, while final expense insurance provides coverage for end-of-life expenses only. Explanation. In Oregon, term life insurance and final expense insurance serve different purposes and have distinct features. Term life insurance provides coverage for a specified period, such as 10, 20, or 30 years, and pays a death benefit if the insured passes away during the term of the policy. Term life insurance is often used to provide income replacement or financial protection for dependents during the insured's working years. On the other hand, final expense insurance is specifically designed to cover end-of-life expenses, such as funeral and burial costs, medical bills, and other debts. Final expense insurance typically does not require a medical exam for approval, making it more accessible for individuals with health concerns. Additionally, final expense insurance policies often feature fixed premiums to provide stability and predictability for policyholders. Question 32. Mr. Patel is comparing final expense insurance policies in Oregon and wants to know if the death benefit can be used for purposes other than funeral expenses. Which of the following accurately describes the flexibility of using the death benefit from a final expense insurance policy? A. The death benefit from final expense insurance policies can only be used for funeral and burial expenses. B. Policyholders have full discretion in determining how to use the death benefit from final expense insurance policies. C. The death benefit from final expense insurance policies can be used for any purpose as long as it is specified in the policy contract. D. The death benefit from final expense insurance policies can be used to pay off outstanding debts of the insured. The correct answer, B. Policyholders have full discretion in determining how to use the death benefit from final expense insurance policies. Explanation. In Oregon, policyholders of final expense insurance policies have full discretion in determining how to use the death benefit received from the policy. While the primary purpose of final expense insurance is to cover funeral and burial expenses, policyholders are not restricted in how they allocate the death benefit. Policyholders may choose to use the death benefit to cover other end-of-life costs, such as medical bills or outstanding debts, or leave a financial legacy for their loved ones. The flexibility of using the death benefit allows policyholders to address their unique financial needs and priorities, providing peace of mind knowing that their loved ones will be financially supported in their absence. Question 33. Mrs. Lee is considering purchasing a final expense insurance policy in Oregon and wants to know if the death benefit is guaranteed. Which of the following accurately describes the guarantee associated with the death benefit in final expense insurance policies? A. The death benefit in final expense insurance policies is guaranteed to increase over time. B. The death benefit in final expense insurance policies is guaranteed to remain constant throughout the life of the policy. C. The death benefit in final expense insurance policies is guaranteed to exceed the policy's cash value. D. The death benefit in final expense insurance policies is guaranteed to be paid out to beneficiaries upon the insured's death. The correct answer, D. The death benefit in final expense insurance policies is guaranteed to be paid out to beneficiaries upon the insured's death. Explanation. In Oregon, the primary guarantee associated with the death benefit in final expense insurance policies is that it will be paid out to beneficiaries upon the insured's death, provided that the policy is in force and all premiums have been paid as required. Unlike other types of life insurance policies where the death benefit may vary based on investment performance or other factors, the death benefit in final expense insurance policies is typically fixed and predetermined at the time of policy issuance. This guarantee ensures that beneficiaries will receive the intended financial protection to cover end-of-life expenses, such as funeral and burial costs, helping to alleviate financial burdens during a difficult time. Question 34. Mr. Thompson is interested in purchasing a final expense insurance policy in Oregon and wants to know if there are any age restrictions for applicants. Which of the following statements accurately describes age restrictions for final expense insurance policies? A. Final expense insurance policies have minimum age requirements but no maximum age limit for applicants. B. Final expense insurance policies have both minimum and maximum age limits for applicants. C. Final expense insurance policies do not have age restrictions for applicants. D. Final expense insurance policies only accept applicants over the age of 65. The correct answer, B. Final expense insurance policies have both minimum and maximum age limits for applicants. Explanation. In Oregon, final expense insurance policies typically have both minimum and maximum age limits for applicants. While the specific age requirements may vary among insurance companies, final expense insurance is generally marketed to individuals who are between the ages of 50 and 85. Some insurance companies may have a minimum age requirement, such as 50 or 55, to ensure that policyholders have reached a certain level of maturity or financial stability. Additionally, there is often a maximum age limit, such as 85, to mitigate the risk for insurance companies and ensure that policyholders do not outlive the coverage period. Age restrictions help insurance companies manage risk and determine appropriate premium rates for final expense insurance policies. Question 35. Ms. Rodriguez is considering purchasing a final expense insurance policy in Oregon and wants to understand how inflation affects the coverage amount. Which of the following accurately describes the impact of inflation on final expense insurance policies? A. Final expense insurance policies include a cost of living adjustment feature to account for inflation. B. Final expense insurance policies provide coverage that increases over time to keep pace with inflation. C. Final expense insurance policies offer fixed coverage amounts that are not affected by inflation. D. Final expense insurance policies require policyholders to adjust their coverage annually based on inflation rates. The correct answer, C. Final expense insurance policies offer fixed coverage amounts that are not affected by inflation. Explanation. In Oregon, final expense insurance policies typically offer fixed coverage amounts that are not affected by inflation. Unlike certain types of insurance policies, such as long-term care insurance or annuities, final expense insurance policies do not include features to adjust coverage amounts based on inflation or changes in the cost of living. The purpose of final expense insurance is to cover specific end-of-life expenses, such as funeral and burial costs, and insurance companies determine the coverage amount based on the insured's needs and preferences at the time of policy issuance. While inflation may impact the purchasing power of the death benefit over time, policyholders can select a coverage amount that aligns with their anticipated expenses and adjust their coverage as needed through policy riders or additional policies. Question 36. Mrs. Foster is comparing final expense insurance policies in Oregon and wants to know if there are any waiting periods for coverage to take effect. Which of the following accurately describes waiting periods for final expense insurance policies? A. Final expense insurance policies have waiting periods before coverage takes effect for all applicants. B. Final expense insurance policies have waiting periods only for applicants with pre-existing medical conditions. C. Final expense insurance policies offer immediate coverage without any waiting periods. D. Final expense insurance policies have waiting periods based on the applicant's age at the time of policy issuance. The correct answer, A. Final expense insurance policies have waiting periods before coverage takes effect for all applicants. Explanation. In Oregon, final expense insurance policies often have waiting periods, also known as elimination periods, before coverage takes effect for all applicants, regardless of their health status. The waiting period typically ranges from 6 months to 2 years, during which time the policyholder must maintain the policy and pay premiums before being eligible for the full death benefit. Waiting periods help insurance companies manage risk and prevent individuals from purchasing coverage shortly before their death to receive the death benefit without sufficient premium payments. While waiting periods may vary among insurance companies, they are a common feature of final expense insurance policies and are disclosed in the policy contract. It's important for applicants to understand the waiting period provisions and how they impact coverage eligibility. Question 37. Mr. Garcia is reviewing his life insurance policy in Oregon and wants to understand the purpose of an accelerated death benefit rider. What is the primary purpose of an accelerated death benefit rider in a life insurance policy? A. To provide additional coverage for critical illnesses. B. To accelerate the payment of a portion of the death benefit if the insured is diagnosed with a terminal illness. C. To waive premium payments if the insured becomes disabled. D. To increase the death benefit over time to keep pace with inflation. The correct answer, B. To accelerate the payment of a portion of the death benefit if the insured is diagnosed with a terminal illness. Explanation. An accelerated death benefit rider, also known as a living benefit rider, allows the policyholder to receive a portion of the death benefit while still alive if diagnosed with a terminal illness. This rider provides financial support to cover medical expenses and other end-of-life costs, allowing the insured to use the funds as needed during a difficult time. It's important to note that the accelerated death benefit is typically subtracted from the total death benefit paid to beneficiaries upon the insured's passing. This rider offers added flexibility and financial security for policyholders facing terminal illnesses. Question 38. Mrs. Johnson is considering purchasing a disability income rider for her life insurance policy in Oregon. What is the primary purpose of a disability income rider in a life insurance policy? A. To provide an additional death benefit if the insured becomes disabled. B. To waive premium payments if the insured becomes disabled. C. To provide a source of income if the insured becomes disabled and is unable to work. D. To increase the cash value of the policy over time. The correct answer, C. To provide a source of income if the insured becomes disabled and is unable to work. Explanation. A disability income rider, also known as a disability income benefit rider, provides a source of income if the insured becomes disabled and is unable to work due to injury or illness. This rider typically pays a monthly benefit to the insured for a specified period, such as 1 or 2 years, during which the insured is unable to earn an income. The purpose of this rider is to replace lost income and help the insured maintain financial stability while unable to work. Unlike disability insurance policies, which provide income protection for a longer duration, disability income riders are designed to complement life insurance coverage and provide short-term financial support in the event of disability. Question 39. Mr. Brown is reviewing his life insurance policy in Oregon and wants to understand the purpose of a waiver of premium rider. What is the primary purpose of a waiver of premium rider in a life insurance policy? A. To provide an additional death benefit if the insured becomes disabled. B. To waive premium payments if the insured becomes disabled. C. To provide a source of income if the insured becomes disabled and is unable to work. D. To increase the cash value of the policy over time. The correct answer, B. To waive premium payments if the insured becomes disabled. Explanation. A waiver of premium rider, also known as a premium waiver benefit rider, waives premium payments if the insured becomes disabled and is unable to work due to injury or illness. This rider ensures that the life insurance coverage remains in force even if the insured cannot afford to pay the premiums due to disability. The waiver of premium rider provides financial relief to the insured during a period of disability and ensures that the policy continues to provide financial protection for the insured's beneficiaries. It's important to review the specific terms and conditions of the rider to understand the eligibility criteria and duration of premium waivers in the event of disability. Question 40. Mrs. Martinez is considering adding a return of premium rider to her life insurance policy in Oregon. What is the primary purpose of a return of premium rider? A. To provide an additional death benefit if the insured passes away during the policy term. B. To refund a portion of the premiums paid if the insured outlives the policy term. C. To accelerate the payment of the death benefit if the insured is diagnosed with a terminal illness. D. To increase the cash value of the policy over time. The correct answer, B. To refund a portion of the premiums paid if the insured outlives the policy term. Explanation. A return of premium rider is designed to refund a portion of the premiums paid if the insured outlives the policy term. Unlike traditional life insurance policies where premiums are not returned if the insured survives the policy term, this rider provides a financial incentive for policyholders by offering the opportunity to recoup a portion of the premiums paid over the policy's duration. It's important to note that return of premium riders typically come with higher premium costs compared to policies without this rider, as it provides an additional benefit of returning premiums if the insured survives the policy term. Question 41. Mr. Nguyen is interested in adding a long-term care rider to his life insurance policy in Oregon. What is the primary purpose of a long-term care rider? A. To provide coverage for medical expenses incurred during a hospital stay. B. To provide a source of income if the insured becomes disabled and is unable to work. C. To accelerate the payment of the death benefit if the insured is diagnosed with a terminal illness. D. To cover the costs of long-term care services, such as nursing home care or in-home care. The correct answer, D. to cover the costs of long-term care services, such as nursing home care or in-home care. Explanation. A long-term care rider is designed to cover the costs of long-term care services, such as nursing home care, assisted living, and in-home care, in the event that the insured becomes unable to perform activities of daily living, ADLs, or requires assistance due to a chronic illness or disability. This rider provides financial protection against the high costs of long-term care, which can quickly deplete savings and assets if not properly planned for. By adding a long-term care rider to a life insurance policy, policyholders can access the death benefit to cover long-term care expenses while still providing a financial legacy for their beneficiaries. Question 42. Ms. Taylor is reviewing her life insurance policy in Oregon and wants to understand the purpose of an accidental death benefit rider. What is the primary purpose of an accidental death benefit rider? A. To provide an additional death benefit if the insured passes away due to an accident. B. To provide coverage for medical expenses incurred during a hospital stay. C. To waive premium payments if the insured becomes disabled. D. To provide a source of income if the insured becomes disabled and is unable to work. The correct answer, A. To provide an additional death benefit if the insured passes away due to an accident. Explanation. An accidental death benefit rider provides an additional death benefit if the insured passes away due to an accident, such as a car accident, slip and fall, or other covered accidental injuries. This rider supplements the base death benefit of the life insurance policy and ensures that beneficiaries receive an increased payout if the insured's death is the result of an accident. Accidental death benefit riders typically have specific terms and conditions outlining what constitutes an accident and any exclusions that may apply. It's important for policyholders to understand the coverage provided by the accidental death benefit rider and how it complements their overall life insurance protection. Question 43. Mr. Anderson is considering adding a guaranteed insurability rider to his life insurance policy in Oregon. What is the primary purpose of a guaranteed insurability rider? A. To provide an additional death benefit if the insured passes away due to an accident. B. To waive premium payments if the insured becomes disabled. C. To increase the coverage amount at specified intervals without evidence of insurability. D. To provide a source of income if the insured becomes disabled and is unable to work. The correct answer, C. To increase the coverage amount at specified intervals without evidence of insurability. Explanation. A guaranteed insurability rider allows the policyholder to increase the coverage amount at specified intervals, such as every 3 or 5 years, without providing evidence of insurability. This means that the insured can purchase additional coverage regardless of changes in health, occupation, or other factors that may affect insurability. The purpose of this rider is to accommodate the insured's changing life circumstances, such as marriage, the birth of a child, or an increase in income, without the need for additional underwriting. Guaranteed insurability riders provide flexibility and ensure that the policy remains aligned with the insured's evolving financial needs. Question 44. Mrs. White is interested in adding a cost of living adjustment rider to her life insurance policy in Oregon. What is the primary purpose of a cost of living adjustment rider? A. To provide an additional death benefit if the insured passes away due to an accident. B. To waive premium payments if the insured becomes disabled. C. To increase the death benefit over time to keep pace with inflation. D. To provide a source of income if the insured becomes disabled and is unable to work. The correct answer, C. To increase the death benefit over time to keep pace with inflation. Explanation. A cost of living adjustment rider, also known as an inflation protection rider, increases the death benefit over time to keep pace with inflation. This rider helps ensure that the purchasing power of the death benefit remains consistent over the life of the policy, accounting for changes in the cost of living and the value of money. By adjusting the death benefit periodically, the policy provides adequate financial protection for the insured's beneficiaries, regardless of economic fluctuations. Cost of living adjustment riders offer added security and peace of mind by safeguarding against the erosion of the death benefit's value over time. Question 45. Mr. Johnson is reviewing his life insurance policy in Oregon and wants to understand the purpose of a conversion rider. What is the primary purpose of a conversion rider? A. To provide an additional death benefit if the insured passes away due to an accident. B. To waive premium payments if the insured becomes disabled. C. To convert a term life insurance policy into a permanent life insurance policy without evidence of insurability. D. To provide a source of income if the insured becomes disabled and is unable to work. The correct answer, C. To convert a term life insurance policy into a permanent life insurance policy without evidence of insurability. Explanation. A conversion rider allows the policyholder to convert a term life insurance policy into a permanent life insurance policy without providing evidence of insurability. This means that the insured can convert the policy to a permanent form of coverage, such as whole life or universal life insurance, regardless of changes in health or other factors that may affect insurability. The purpose of this rider is to provide flexibility and ensure that the insured has the option to maintain coverage beyond the initial term of the policy without undergoing additional underwriting. Conversion riders offer added security and peace of mind by allowing policyholders to adapt their coverage to meet their changing needs over time. Question 46. Mr. Davis, an insurance agent in Oregon, is preparing marketing materials for a new life insurance policy. Which of the following practices would be considered unethical in insurance marketing and advertising? A. Promising guaranteed returns on investment-linked insurance products. B. Providing accurate and transparent information about policy features and benefits. C. Using deceptive language to pressure potential clients into purchasing insurance. D. Disclosing potential risks and limitations associated with the policy. The correct answer, C. Using deceptive language to pressure potential clients into purchasing insurance. Explanation. Using deceptive language or engaging in high-pressure sales tactics to coerce individuals into purchasing insurance is considered unethical in insurance marketing and advertising. Ethical marketing practices prioritize transparency, honesty, and integrity in all communications with clients. Agents should provide accurate information about policy features, benefits, and potential risks to help clients make informed decisions that align with their needs and financial goals. Engaging in deceptive practices can damage the reputation of the insurance industry and erode trust between agents and clients. Question 47. Ms. Lee, an insurance agent in Oregon, is creating an advertising campaign for health insurance plans. Which of the following statements best reflects ethical principles in insurance marketing and advertising? A. Emphasizing the benefits of the health insurance plans without disclosing coverage limitations. B. Ensuring that all advertising materials comply with state regulations and licensing requirements. C. Making false claims about the superiority of the health insurance plans compared to competitors. D. Targeting vulnerable populations with misleading advertisements to maximize sales. The correct answer, B. Ensuring that all advertising materials comply with state regulations and licensing requirements. Explanation. Ethical principles in insurance marketing and advertising require agents to ensure that all advertising materials comply with state regulations and licensing requirements. This includes providing accurate and complete information about insurance products, disclosing coverage limitations and exclusions, and avoiding false or misleading statements. Agents have a responsibility to act in the best interests of consumers and maintain the integrity of the insurance industry. Adhering to ethical standards helps build trust with clients and promotes transparency and fairness in insurance marketing practices. Question 48. Mr. Harris, an insurance agent in Oregon, is considering using social media to promote insurance products. Which of the following guidelines should Mr. Harris follow to maintain ethical standards in social media marketing? A. Posting exaggerated claims about the benefits of insurance products to attract more followers. B. Engaging with clients in private messages to discuss insurance options and premiums. C. Obtaining permission from clients before sharing their personal information or testimonials. D. Creating fake accounts to leave positive reviews for his insurance agency. The correct answer, C. Obtaining permission from clients before sharing their personal information or testimonials. Explanation. Maintaining ethical standards in social media marketing involves obtaining permission from clients before sharing their personal information or testimonials. Agents should respect client privacy and confidentiality and obtain explicit consent before using their information or endorsements in marketing materials. Additionally, agents should refrain from engaging in deceptive practices, such as posting exaggerated claims or creating fake accounts to manipulate online reviews. Ethical social media marketing fosters trust, credibility, and transparency in the insurance industry, strengthening relationships with clients and promoting positive brand reputation. Question 49. Ms. Rodriguez, an insurance agent in Oregon, is attending a networking event and encounters a potential client. During their conversation, the client expresses concerns about his current insurance coverage. Which of the following actions would demonstrate ethical behavior by Ms. Rodriguez in this situation? A. Providing inaccurate information about competitors' insurance products to make her own offerings seem superior. B. Advising the client to cancel his existing policy immediately and switch to her insurance products. C. Offering to review the client's current coverage and provide objective recommendations based on his needs and circumstances. D. Pressuring the client to make a decision on the spot without allowing him time to consider his options. The correct answer, C. Offering to review the client's current coverage and provide objective recommendations based on his needs and circumstances. Explanation. Providing objective recommendations based on the client's needs and circumstances demonstrates ethical behavior in insurance marketing. Ms. Rodriguez should offer to review the client's current coverage to understand his situation better and provide informed advice. Pressuring the client to make immediate decisions or providing inaccurate information about competitors' products would be unethical and could harm the client's interests. Ethical agents prioritize the best interests of clients and strive to build trust through honesty, transparency, and professionalism. Question 50. Mr. Thompson, an insurance agent in Oregon, is creating an advertisement for a new life insurance policy. Which of the following statements accurately reflects ethical considerations in insurance advertising? A. Using fear tactics to persuade individuals to purchase life insurance without considering their financial situation or needs. B. Including fine print and disclaimers in advertisements to minimize transparency and disclosure. C. Ensuring that advertising materials are clear, accurate, and provide sufficient information for consumers to make informed decisions. D. Making unrealistic promises about investment returns or guaranteed benefits to attract potential clients. The correct answer, C. Ensuring that advertising materials are clear, accurate, and provide sufficient information for consumers to make informed decisions. Explanation. Ethical considerations in insurance advertising require agents to ensure that advertising materials are clear, accurate, and provide sufficient information for consumers to make informed decisions. Transparency and disclosure are essential to building trust with clients and maintaining the integrity of the insurance industry. Using fear tactics, misleading statements, or making unrealistic promises would be unethical and could harm consumers' interests. Agents should prioritize honesty, integrity, and professionalism in all aspects of insurance marketing and advertising. Question 51. Ms. Patel, an insurance agent in Oregon, is considering offering incentives to clients who refer new customers to her agency. Which of the following actions would be ethical when implementing a referral program? A. Offering cash rewards to clients for referring friends or family members to purchase insurance products. B. Providing discounts on insurance premiums for clients who refer a specified number of new customers. C. Disclosing the terms and conditions of the referral program, including any eligibility criteria or limitations. D. Offering incentives only to clients who refer individuals with pre-existing medical conditions to purchase insurance. The correct answer, C. Disclosing the terms and conditions of the referral program, including any eligibility criteria or limitations. Explanation. When implementing a referral program, Ethical agents should disclose the terms and conditions of the program, including any eligibility criteria or limitations. Providing clear and transparent information helps ensure that clients understand the referral process and any rewards or incentives they may receive. Offering incentives for referrals can be an ethical practice if implemented fairly and transparently. However, agents should avoid discriminatory practices or providing incentives based on factors such as pre-existing medical conditions, as this could be considered unethical and discriminatory. Ethical referral programs prioritize fairness, transparency, and integrity in rewarding clients for their referrals. Question 52. Mr. Jackson, an insurance agent in Oregon, is creating an advertisement for a new health insurance plan. Which of the following statements best reflects ethical considerations in insurance advertising? A. Making misleading statements about the coverage and benefits of the health insurance plan to attract more customers. B. Ensuring that the advertisement prominently features testimonials from satisfied customers without verifying their authenticity. C. Providing accurate and clear information about the terms, conditions, and limitations of the health insurance plan. D. Using high-pressure sales tactics to urge potential customers to purchase the health insurance plan immediately. The correct answer: C. Providing accurate and clear information about the terms, conditions, and limitations of the health insurance plan. Explanation: Ethical considerations in insurance advertising prioritize providing accurate and clear information about the terms, conditions, and limitations of the insurance plan. Agents should avoid making misleading statements or using deceptive practices to attract customers. Providing transparent information helps consumers make informed decisions about their insurance coverage and fosters trust between the agent and the customer. Ethical agents prioritize honesty, integrity, and professionalism in all aspects of insurance marketing and advertising. Question 53. Ms. Nguyen, an insurance agent in Oregon, is considering hosting a seminar to educate the community about retirement planning and insurance options. Which of the following actions would demonstrate ethical behavior in organizing the seminar? A. Charging attendees a high fee for attending the seminar without providing value or relevant information. B. Inviting only individuals who are likely to purchase insurance products from her agency. C. Providing objective information about various retirement planning strategies and insurance products without bias or sales pressure. D. Promising attendees guaranteed returns or benefits if they purchase insurance products during the seminar. The correct answer: C. Providing objective information about various retirement planning strategies and insurance products without bias or sales pressure. Explanation: Demonstrating ethical behavior in organizing a seminar involves providing objective information about various retirement planning strategies and insurance products without bias or sales pressure. The seminar should focus on educating attendees and helping them make informed decisions about their financial future. Charging excessive fees or targeting only potential customers would be unethical and could undermine the credibility of the seminar. Ethical agents prioritize transparency, honesty, and professionalism in all educational efforts aimed at the community. Question 54. Mr. Roberts, an insurance agent in Oregon, is considering advertising his insurance agency on social media platforms. Which of the following actions would be ethical when using social media for insurance marketing? A. Purchasing fake followers or likes to artificially boost his social media presence. B. Using deceptive language or clickbait headlines to attract more clicks and engagement. C. Engaging with followers by providing valuable content, answering questions, and addressing concerns. D. Posting negative reviews or comments about competing insurance agencies to undermine their reputation. The correct answer: C. Engaging with followers by providing valuable content, answering questions, and addressing concerns. Explanation: Engaging with followers by providing valuable content, answering questions, and addressing concerns demonstrates ethical behavior in social media marketing. Agents should prioritize building genuine relationships with their audience and providing helpful information that adds value. Using deceptive practices or engaging in negative behavior, such as purchasing fake followers or posting negative comments about competitors, would be unethical and could damage the agent's reputation. Ethical social media marketing involves transparency, honesty, and professionalism in all interactions with followers and the online community. Question 55. Mr. Thompson, an insurance agent in Oregon, is considering offering gifts to clients as a token of appreciation for their business. Which of the following actions would adhere to professional codes of conduct for insurance agents and brokers? A. Offering expensive gifts to clients to encourage them to purchase additional insurance products. B. Providing modest, non-monetary gifts to clients as expressions of gratitude for their loyalty and trust. C. Offering cash incentives to clients who refer new customers to the agency. D. Promising discounted premiums or special deals to clients in exchange for positive online reviews. The correct answer, B. Providing modest, non-monetary gifts to clients as expressions of gratitude for their loyalty and trust. Explanation. Professional codes of conduct for insurance agents and brokers encourage ethical behavior and integrity in client relationships. Providing modest, non-monetary gifts to clients as expressions of gratitude for their loyalty and trust is acceptable within ethical guidelines. However, offering expensive gifts, cash incentives for referrals, or special deals in exchange for positive reviews may be considered unethical and could violate industry regulations. Ethical agents prioritize transparency, honesty, and fairness in all interactions with clients, maintaining the integrity of the insurance profession. Question 56. Ms. Roberts, an insurance broker in Oregon, is preparing to meet with a client to discuss insurance options. Which of the following actions would demonstrate adherence to professional codes of conduct for insurance agents and brokers during the client meeting? A. Pressuring the client to purchase insurance products that may not be suitable for their needs. B. Providing accurate and objective information about various insurance options, including coverage, benefits, and costs. C. Withholding important information about policy terms and conditions to make the insurance products appear more attractive. D. Advising the client to conceal certain details about their medical history to obtain lower premiums. The correct answer, B. Providing accurate and objective information about various insurance options, including coverage, benefits, and costs. Explanation. Adhering to professional codes of conduct for insurance agents and brokers involves providing accurate and objective information to clients to help them make informed decisions. Ms. Roberts should offer clear explanations of various insurance options, including coverage, benefits, and costs, without pressuring the client to make a specific purchase. Withholding important information or advising clients to conceal details about their medical history would be unethical and could compromise the client's financial security. Ethical agents prioritize the best interests of clients and maintain transparency and honesty in all interactions. Question 57. Mr. Patel, an insurance agent in Oregon, is considering recommending a particular insurance product to a client. Which of the following factors should Mr. Patel consider to ensure compliance with professional codes of conduct for insurance agents and brokers? A. The commission rate offered by the insurance company for selling the product. B. The client's financial needs, goals, and risk tolerance. C. The popularity of the product among other agents in the industry. D. The potential for earning bonuses or incentives for selling the product. The correct answer, B. The client's financial needs, goals, and risk tolerance. Explanation. Professional codes of conduct for insurance agents and brokers prioritize the best interests of clients. Mr. Patel should consider the client's financial needs, goals, and risk tolerance when recommending an insurance product. Tailoring recommendations to align with the client's specific circumstances helps ensure that the chosen product provides adequate coverage and meets the client's objectives. Considering factors such as commission rates, product popularity among other agents, or potential incentives should not override the importance of addressing the client's needs ethically and responsibly. Ethical agents prioritize transparency, honesty, and integrity in all client interactions, maintaining the trust and confidence of their clients. Question 58. Ms. Garcia, an insurance agent in Oregon, is reviewing her client list and notices that one of her clients has a policy that may no longer suit their needs. What should Ms. Garcia do to adhere to professional codes of conduct? A. Encourage the client to keep their existing policy without discussing potential alternatives. B. Immediately cancel the existing policy and sell the client a new one without exploring other options. C. Schedule a meeting with the client to review their current policy and discuss any changes in their circumstances or needs. D. Offer the client additional coverage options without considering their current policy's adequacy. The correct answer: C. Schedule a meeting with the client to review their current policy and discuss any changes in their circumstances or needs. Explanation: adhering to professional codes of conduct requires agents to act in the best interests of their clients. Ms. Garcia should schedule a meeting with the client to review their current policy and discuss any changes in their circumstances or needs. This approach allows Ms. Garcia to assess whether the existing policy remains suitable or if adjustments are necessary. Encouraging clients to keep their existing policy without discussion or immediately canceling it without exploring alternatives could be seen as neglecting the client's best interests. Question 59. Mr. Lewis, an insurance broker in Oregon, is preparing to recommend a policy to his client. In accordance with professional codes of conduct, which of the following should be Mr. Lewis' primary consideration? A. The policy with the highest commission rate for the broker. B. The policy that offers the most extensive coverage, regardless of the client's needs. C. The policy that best fits the client's financial situation, goals, and risk tolerance. D. The policy with the most appealing marketing materials and advertisements. The correct answer: C. The policy that best fits the client's financial situation, goals, and risk tolerance. Explanation: professional codes of conduct prioritize recommending insurance policies that align with the client's financial situation, goals, and risk tolerance. Mr. Lewis should carefully consider the client's individual circumstances and needs when making recommendations, rather than focusing solely on factors such as commission rates or marketing materials. Providing tailored advice demonstrates integrity and commitment to acting in the client's best interests. Question 60. Ms. Parker, an insurance agent in Oregon, receives a referral from a colleague for a potential client. What should Ms. Parker do to comply with professional codes of conduct? A. Offer the potential client discounts on premiums to incentivize them to purchase insurance. B. Thank her colleague for the referral and reach out to the potential client to schedule a meeting. C. Ignore the referral and focus on acquiring new clients independently. D. Promise the potential client guaranteed returns on their investment if they choose to purchase insurance from her. The correct answer: B. Thank her colleague for the referral and reach out to the potential client to schedule a meeting. Explanation: professional codes of conduct emphasize ethical behavior and professionalism in client interactions. Ms. Parker should thank her colleague for the referral and reach out to the potential client to schedule a meeting. Referrals are an essential part of building relationships in the insurance industry, and agents should handle them with appreciation and respect. Offering discounts or making unrealistic promises to potential clients would be unethical and could damage trust within the industry. Question 61. Mr. Nguyen, an insurance agent in Oregon, is approached by a potential client who asks about the differences between two insurance policies. According to professional codes of conduct, what should Mr. Nguyen prioritize in his response? A. Emphasize the policy with the highest commission rate for the agent. B. Provide objective information about the features, benefits, and limitations of each policy. C. Persuade the client to purchase the policy that offers the most extensive coverage. D. Recommend the policy endorsed by the majority of agents in the industry. The correct answer: B. Provide objective information about the features, benefits, and limitations of each policy. Explanation: Professional codes of conduct require agents to provide objective and unbiased information to clients. Mr. Nguyen should prioritize providing objective information about the features, benefits, and limitations of each policy, allowing the client to make an informed decision based on their needs and preferences. Emphasizing commission rates, persuading clients to purchase specific policies, or recommending policies based on industry trends may compromise the agent's integrity and violate ethical standards. Question 62. Ms. Martinez, an insurance broker in Oregon, is considering advertising her services online. What should Ms. Martinez keep in mind to comply with professional codes of conduct? A. Make exaggerated claims about the benefits of her services to attract more clients. B. Provide clear and accurate information about her qualifications, services offered, and contact details. C. Hide negative reviews or feedback from previous clients to maintain a positive online reputation. D. Offer discounts on premiums exclusively to individuals who engage with her advertisements on social media. The correct answer, B. Provide clear and accurate information about her qualifications, services offered, and contact details. Explanation. Professional codes of conduct emphasize honesty, transparency, and professionalism in advertising practices. Ms. Martinez should provide clear and accurate information about her qualifications, services offered, and contact details in her online advertisements. Exaggerated claims, hiding negative feedback, or offering exclusive discounts based on social media engagement may mislead potential clients and undermine trust in the insurance industry. Question 63. Mr. Kim, an insurance agent in Oregon, is preparing to meet with a client who has experienced financial difficulties. How should Mr. Kim approach the client's situation in accordance with professional codes of conduct? A. Pressure the client to purchase additional insurance products to alleviate their financial troubles. B. Provide empathetic support and explore options to adjust the client's existing policies to better suit their current financial situation. C. Ignore the client's financial difficulties and focus solely on selling new insurance policies. D. Promise the client guaranteed returns on investments if they choose to purchase insurance from him. The correct answer, B. Provide empathetic support and explore options to adjust the client's existing policies to better suit their current financial situation. Explanation. Professional codes of conduct emphasize empathy, integrity, and client-focused solutions. Mr. Kim should provide empathetic support to the client and explore options to adjust their existing policies to better suit their current financial situation. Pressuring the client to purchase additional products or making unrealistic promises would be unethical and could exacerbate the client's financial difficulties. Ethical agents prioritize the best interests of clients and act with integrity and professionalism in all client interactions. Question 64. Mrs. Thompson, an insurance underwriter in Oregon, is reviewing an applicant's health history. Which of the following actions would demonstrate ethical behavior in the underwriting process? A. Denying coverage to the applicant based on their age alone, without considering other relevant factors. B. Requesting additional medical information from the applicant's healthcare providers to make an informed decision. C. Offering discounted premiums to applicants with pre-existing conditions to attract more customers. D. Automatically approving all applicants without conducting a thorough review of their health history. The correct answer, B. Requesting additional medical information from the applicant's healthcare providers to make an informed decision. Explanation. Ethical underwriting involves gathering relevant information to assess the risk accurately. Requesting additional medical information from the applicant's healthcare providers demonstrates a commitment to making informed decisions based on comprehensive data. Denying coverage based solely on age, offering discounts based on pre-existing conditions, or approving applicants without proper evaluation could lead to unfair treatment and adverse selection, violating ethical standards in underwriting. Question 65. Mr. Rodriguez, an insurance claims adjuster in Oregon, is handling a claim for property damage. Which of the following actions would adhere to ethical standards in claims handling? A. Denying the claim without conducting a thorough investigation or providing a clear explanation to the policyholder. B. Offering a settlement amount significantly lower than the actual value of the damaged property. C. Providing timely updates and clear communication to the policyholder throughout the claims process. D. Delaying the claims process to avoid paying the policyholder's benefits within the policy's timeframe. The correct answer, C. Providing timely updates and clear communication to the policyholder throughout the claims process. Explanation. Ethical claims handling involves transparency, fairness, and timely communication with policyholders. Providing timely updates and clear communication throughout the claims process helps maintain trust and ensures policyholders are informed about the status of their claims. Denying claims without proper investigation, offering inadequate settlements, or delaying the process unfairly disadvantages policyholders and violates ethical standards in claims handling. Question 66. Ms. Lee, an insurance underwriter in Oregon, receives an application with incomplete information from an applicant. What should Ms. Lee do to comply with ethical principles in underwriting? A. Proceed with the underwriting process based on the available information without requesting additional details. B. Contact the applicant to request the missing information needed to assess the risk accurately. C. Reject the application immediately due to incomplete information. D. Adjust the premium rates arbitrarily to compensate for the missing information. The correct answer, B. Contact the applicant to request the missing information needed to assess the risk accurately. Explanation. Ethical underwriting requires thorough assessment and consideration of all relevant information. Ms. Lee should contact the applicant to request the missing information necessary to assess the risk accurately. Rejecting the application or proceeding without complete information could lead to unfair outcomes and violate ethical principles. Adjusting premium rates arbitrarily also undermines fairness and transparency in the underwriting process. Ethical underwriters prioritize gathering comprehensive data to make informed decisions and ensure fairness for all applicants. Question 67. Mr. Harris, an insurance underwriter in Oregon, is reviewing an applicant's medical history and discovers a pre-existing condition. What should Mr. Harris consider when evaluating the applicant's eligibility for coverage? A. Denying coverage solely based on the pre-existing condition without considering other factors. B. Assessing the severity and stability of the pre-existing condition and its impact on the applicant's insurability. C. Automatically approving the application to avoid potential legal disputes. D. Offering coverage at significantly higher premiums without providing justification to the applicant. The correct answer, B. Assessing the severity and stability of the pre-existing condition and its impact on the applicant's insurability. Explanation. Ethical underwriting involves evaluating the applicant's overall health and assessing the impact of pre-existing conditions on their insurability. Mr. Harris should consider the severity, stability, and treatment of the pre-existing condition, along with other relevant factors, to make a fair and informed decision. Denying coverage solely based on a pre-existing condition, automatically approving applications, or imposing significantly higher premiums without justification would not adhere to ethical standards in underwriting. Question 68. Ms. Patel, an insurance claims adjuster in Oregon, receives conflicting information regarding a claim from different sources. What should Ms. Patel do to handle the situation ethically? A. Disregard the conflicting information and proceed with the claim settlement process. B. Investigate further to reconcile the discrepancies and ensure an accurate assessment of the claim. C. Deny the claim to avoid potential complications arising from conflicting information. D. Settle the claim quickly to avoid further delays, regardless of the conflicting information. The correct answer, B. Investigate further to reconcile the discrepancies and ensure an accurate assessment of the claim. Explanation. Ethical claims handling requires thorough investigation and resolution of discrepancies to ensure fair treatment of policyholders. Ms. Patel should investigate further to reconcile the conflicting information and obtain a clear understanding of the claim's circumstances. Disregarding the discrepancies, denying the claim, or settling it hastily could lead to unfair outcomes and undermine trust in the claim's handling process. Question 69. Mr. Thompson, an insurance underwriter in Oregon, is assessing the risk of insuring a new applicant. What should Mr. Thompson prioritize when determining the applicant's eligibility for coverage? A. The applicant's willingness to pay higher premiums. B. The accuracy and completeness of the information provided by the applicant. C. The underwriter's personal opinions or biases. D. The applicant's relationship with other policyholders within the insurance company. The correct answer, B. The accuracy and completeness of the information provided by the applicant. Explanation. Ethical underwriting requires reliance on accurate and complete information provided by the applicant. Mr. Thompson should prioritize assessing the accuracy and completeness of the applicant's information to make an informed decision about their eligibility for coverage. Relying on personal opinions or biases, considering the applicant's willingness to pay higher premiums, or evaluating their relationship with other policyholders would not align with ethical standards in underwriting. Question 70. Ms. Campbell, an insurance claims adjuster in Oregon, receives a claim that seems fraudulent based on her initial assessment. What should Ms. Campbell do to handle this situation ethically? A. Approve the claim to avoid potential conflict with the policyholder. B. Investigate the claim further to gather evidence before making a decision. C. Deny the claim without further investigation to prevent fraudulent payouts. D. Delay the claims process indefinitely to avoid addressing the fraudulent claim. The correct answer, B. Investigate the claim further to gather evidence before making a decision. Explanation. Ethical claims handling requires thorough investigation to substantiate suspicions of fraud before taking action. Ms. Campbell should investigate the claim further to gather evidence and confirm whether it is indeed fraudulent. Approving or denying the claim without proper investigation could lead to unfair treatment of the policyholder and potential legal repercussions. Delaying the claims process indefinitely also fails to address the issue and may harm the policyholder's interests. Question 71. Mr. Evans, an insurance underwriter in Oregon, is evaluating an application from an applicant with a history of mental health issues. What should Mr. Evans consider when assessing the applicant's eligibility for coverage? A. Deny coverage based solely on the applicant's mental health history to mitigate risk. B. Evaluate the current stability and management of the applicant's mental health condition. C. Automatically approve the application to avoid potential discrimination. D. Increase premiums substantially without providing justification to the applicant. The correct answer, B. Evaluate the current stability and management of the applicant's mental health condition. Explanation. Ethical underwriting involves assessing the applicant's current health status and stability, including any mental health issues, to determine their eligibility for coverage. Mr. Evans should evaluate the current stability and management of the applicant's mental health condition rather than denying coverage solely based on their history. Automatically approving applications or increasing premiums without justification could lead to discriminatory practices and violate ethical standards in underwriting. Question 72. Ms. Foster, an insurance claims adjuster in Oregon, receives conflicting information from the policyholder and the repair shop regarding the cause of a car accident. How should Ms. Foster handle this situation ethically? A. Favor the policyholder's account of the accident without further investigation. B. Conduct an impartial investigation to determine the true cause of the accident. C. Deny the claim to avoid potential disputes arising from conflicting information. D. Settle the claim quickly to avoid further complications, regardless of the conflicting information. The correct answer, B. Conduct an impartial investigation to determine the true cause of the accident. Explanation. Ethical claims handling requires impartiality and thorough investigation to determine the facts of the claim accurately. Ms. Foster should conduct an impartial investigation to gather evidence and determine the true cause of the accident, considering both the policyholder's account and the repair shop's information. Failing to investigate or favoring one party's account without evidence could lead to unfair outcomes and damage trust in the claims handling process. Question 73. Mr. Anderson, an insurance agent in Oregon, is advising a client on purchasing a life insurance policy. During the consultation, Mr. Anderson recommends a policy that offers him higher commissions compared to other available options. What ethical concern does this situation raise? A. Mr. Anderson's duty to act in the best interest of the client. B. Mr. Anderson's obligation to disclose his commission structure to the client. C. Mr. Anderson's responsibility to prioritize the insurer's interests. D. Mr. Anderson's need to provide accurate policy information to the client. The correct answer, A. Mr. Anderson's duty to act in the best interest of the client. Explanation. In Oregon, insurance agents have a fiduciary duty to act in the best interests of their clients. Recommending a policy solely based on higher commissions without considering the client's needs may constitute a conflict of interest. Agents should prioritize the client's interests above their own financial gain and provide recommendations that align with the client's goals and circumstances. Question 74. Ms. Garcia, an insurance producer in Oregon, is selling health insurance policies to individuals. She recommends a policy offered by a particular insurer because the company provides her with additional perks and incentives for meeting sales targets. What ethical principle is Ms. Garcia potentially violating? A. Full disclosure of compensation arrangements. B. Disclosure of potential conflicts of interest. C. The duty to maintain client confidentiality. D. The obligation to provide accurate information about policies. The correct answer, B. Disclosure of potential conflicts of interest. Explanation. Insurance producers in Oregon have a duty to disclose potential conflicts of interest to clients. By recommending a policy based on personal incentives from the insurer, Ms. Garcia may not be transparent about the factors influencing her recommendation. Clients have the right to know if an agent's recommendations are influenced by incentives or other conflicts of interest to make informed decisions about their insurance coverage. Question 75. Mr. Thompson, an insurance broker in Oregon, represents multiple insurance companies. He suggests a life insurance policy from Company A to a client, even though Company B offers a similar policy with better coverage at a lower premium. What ethical concern does this situation raise? A. Mr. Thompson's obligation to disclose his relationship with multiple insurance companies. B. Mr. Thompson's duty to recommend policies that best suit the client's needs. C. Mr. Thompson's responsibility to prioritize his financial interests. D. Mr. Thompson's need to obtain consent from both insurance companies before making recommendations. The correct answer, B. Mr. Thompson's duty to recommend policies that best suit the client's needs. Explanation. As an insurance broker, Mr. Thompson has a duty to recommend policies that best meet the client's needs, even if it means suggesting products from competing insurers. Failing to provide the client with the best available options may constitute a conflict of interest. Mr. Thompson should prioritize the client's interests and disclose any relationships with insurance companies that could influence his recommendations. Question 76. Ms. Roberts, an insurance agent in Oregon, has a close personal relationship with a particular insurance company. When advising clients on purchasing policies, she consistently recommends products offered by this company, even if they may not be the best fit for the client's needs. What ethical principle is Ms. Roberts violating? A. The duty to provide accurate information about policies. B. The obligation to disclose potential conflicts of interest. C. The responsibility to prioritize client confidentiality. D. The requirement to maintain professional competence. The correct answer, B. The obligation to disclose potential conflicts of interest. Explanation. Ms. Roberts should disclose her personal relationship with the insurance company to clients, as it may create a conflict of interest. Failing to do so could result in biased recommendations that do not align with the client's best interests. Transparently disclosing potential conflicts of interest allows clients to make informed decisions about their insurance purchases. Question 77. Mr. Nguyen, an insurance producer in Oregon, receives higher commissions for selling certain types of life insurance policies compared to others. When advising clients, he emphasizes these policies, even though they may not be the most suitable for the client's needs. What ethical principle should Mr. Nguyen prioritize in his recommendations? A. Maximizing his commission earnings. B. Acting in the best interests of the clients. C. Following the insurer's sales targets. D. Providing policies with the most features and benefits. The correct answer, B. Acting in the best interests of the clients. Explanation. Mr. Nguyen should prioritize acting in the best interests of his clients, even if it means recommending policies with lower commissions. Focusing solely on maximizing commissions may lead to biased recommendations and conflicts of interest. By prioritizing the client's needs and objectives, Mr. Nguyen can uphold ethical standards in insurance sales. Question 78. Ms. Lewis, an insurance broker in Oregon, represents multiple insurance companies. When advising clients on purchasing health insurance, she provides them with comprehensive information about the policies offered by each company, including their benefits and limitations. What ethical principle does Ms. Lewis demonstrate in her approach? A. Full disclosure of compensation arrangements. B. Transparency in presenting policy options. C. The obligation to maintain client confidentiality. D. Compliance with state insurance regulations. The correct answer, B. Transparency in presenting policy options. Explanation. Ms. Lewis demonstrates transparency by providing clients with comprehensive information about the policies offered by various insurance companies. By presenting all available options and disclosing their benefits and limitations, she enables clients to make informed decisions based on their needs and preferences. This approach aligns with ethical standards in insurance sales and recommendations. Question 79. Mr. Thompson, an insurance agent in Oregon, receives additional compensation from an insurance company for meeting certain sales targets. He consistently recommends policies from this company to his clients, even though other insurers may offer better coverage options. What ethical concern does this situation raise? A. Mr. Thompson's obligation to provide accurate information about policies. B. Mr. Thompson's duty to act in the best interest of the client. C. Mr. Thompson's responsibility to prioritize his financial interests. D. Mr. Thompson's need to obtain consent from the insurance company before making recommendations. The correct answer, B. Mr. Thompson's duty to act in the best interest of the client. Explanation. Mr. Thompson should prioritize his client's best interests over his own financial gain. Recommending policies solely based on additional compensation from the insurance company may create a conflict of interest. Ethically, Mr. Thompson should provide unbiased recommendations that align with the client's needs and circumstances. Question 80. Ms. Patel, an insurance producer in Oregon, has a personal relationship with an insurance company's representative. When advising clients on purchasing insurance policies, she consistently recommends products from this company, even if they may not be the most suitable options. What ethical principle should Ms. Patel prioritize in her recommendations? A. Maximizing her personal relationships. B. Following the insurer's sales targets. C. Providing policies with the highest commissions. D. Acting in the best interests of her clients. The correct answer, D. Acting in the best interests of her clients. Explanation. Ms. Patel should prioritize acting in the best interests of her clients, regardless of her personal relationships or potential financial gain. Focusing on client needs and objectives ensures that her recommendations are ethical and aligned with the client's requirements. Question 81. Mr. Evans, an insurance broker in Oregon, represents multiple insurance companies. When advising clients on purchasing policies, he fails to disclose his relationships with these insurers and biases his recommendations toward companies that offer higher commissions. What ethical obligation is Mr. Evans neglecting? A. The duty to provide accurate information about policies. B. The obligation to disclose potential conflicts of interest. C. The responsibility to prioritize client confidentiality. D. Compliance with state insurance regulations. The correct answer, B. The obligation to disclose potential conflicts of interest. Explanation: Mr. Evans should disclose his relationships with insurance companies to clients to avoid potential conflicts of interest. Failing to do so may undermine trust in his recommendations and could result in biased advice that does not serve the client's best interests. Transparently disclosing potential conflicts of interest allows clients to make informed decisions about their insurance purchases. Question 82. Mr. Davis, an insurance agent in Oregon, is advising a client on purchasing a health insurance policy. During the consultation, Mr. Davis fails to disclose crucial information about policy exclusions and limitations that could impact the client's coverage. Which ethical principle is Mr. Davis violating? A. The duty of full disclosure to clients. B. The obligation to maximize commissions. C. The responsibility to maintain client confidentiality. D. The requirement to prioritize insurer interests. The correct answer, A. The duty of full disclosure to clients. Explanation: Insurance agents have a duty to provide clients with all relevant information necessary for them to make informed decisions. Failing to disclose policy exclusions and limitations violates this duty of full disclosure. Agents must ensure transparency in their dealings with clients to uphold ethical standards and maintain trust. Question 83. Ms. Roberts, an insurance broker in Oregon, receives commission incentives from multiple insurance companies. When recommending policies to clients, she emphasizes products from insurers that offer her higher commissions, even if they may not be the most suitable options. What ethical principle should Ms. Roberts prioritize in her recommendations? A. Prioritizing personal financial gain. B. Acting in the best interests of the client. C. Maximizing sales for insurance companies. D. Protecting confidential client information. The correct answer, B. Acting in the best interests of the client. Explanation: As an insurance broker, Ms. Roberts has a fiduciary duty to act in the best interests of her clients. This duty supersedes any financial incentives she may receive from insurance companies. Prioritizing client needs ensures ethical conduct and helps maintain trust and integrity in the insurance industry. Question 84. Mr. Johnson, an insurance producer in Oregon, learns about a new policy provision that could significantly benefit his clients. However, the provision is not yet widely known in the industry. What should Mr. Johnson do to uphold ethical standards? A. Keep the information confidential to maintain a competitive advantage. B. Share the information selectively with only his most valued clients. C. Disclose the information to all clients who may benefit from it. D. Consult with other insurance producers to determine the best course of action. The correct answer, C. Disclose the information to all clients who may benefit from it. Explanation: Upholding ethical standards requires transparency and fairness in dealings with clients. Mr. Johnson should disclose the new policy provision to all clients who may benefit from it, ensuring equal access to valuable information. This fosters trust and integrity in client-agent relationships and demonstrates a commitment to acting in the client's best interests. Question 85. Ms. Adams, an insurance agent in Oregon, has a close personal relationship with the client. During a consultation, the client reveals confidential information about their health history. What should Ms. Adams do to maintain ethical conduct? A. Use the client's health information to recommend suitable insurance policies. B. Share the client's health information with other insurance agents for networking purposes. C. Maintain strict confidentiality regarding the client's health information. D. Disclose the client's health information to the insurance company for underwriting purposes. The correct answer, C. Maintain strict confidentiality regarding the client's health information. Explanation. As an insurance agent, Ms. Adams is bound by confidentiality obligations regarding client information, including health history. It is essential for her to maintain strict confidentiality to protect the client's privacy and uphold ethical standards. Question 86. Mr. Garcia, an insurance producer in Oregon, encounters a situation where a client's needs may be better served by a policy offered by a different insurance company than the one he represents. What ethical obligation does Mr. Garcia have in this situation? A. Recommend the policy offered by the insurance company he represents. B. Disclose his relationship with the insurance company to the client. C. Advise the client to seek guidance from another insurance producer. D. Prioritize his financial interests over the client's needs. The correct answer, B. Disclose his relationship with the insurance company to the client. Explanation. Mr. Garcia has an ethical obligation to disclose his relationship with the insurance company to the client. Transparency allows the client to make an informed decision and ensures that Mr. Garcia acts in the client's best interests. Question 87. Ms. Nguyen, an insurance broker in Oregon, receives an offer from an insurance company for a luxurious vacation in exchange for meeting certain sales targets. What ethical concern does this situation raise? A. Ms. Nguyen's obligation to disclose the offer to her clients. B. The potential conflict of interest between Ms. Nguyen's personal interests and her client's interests. C. The requirement for Ms. Nguyen to maximize her commission earnings. D. The necessity for Ms. Nguyen to accept the offer to maintain positive relationships with insurance companies. The correct answer, B. The potential conflict of interest between Ms. Nguyen's personal interests and her client's interests. Explanation. Accepting gifts or incentives from insurance companies may create a conflict of interest for Ms. Nguyen, as it could influence her recommendations to clients. Ethically, she should prioritize her client's interests over personal gain and avoid situations that may compromise her objectivity. Question 88. Mr. Wilson, an insurance agent in Oregon, encounters a client who is considering surrendering their life insurance policy to purchase a new one. Instead of explaining the potential consequences and costs of surrendering the policy, Mr. Wilson encourages the client to proceed with the new purchase. What ethical principle is Mr. Wilson violating? A. The duty to prioritize the client's financial interests. B. The obligation to provide accurate and complete information. C. The responsibility to maximize commissions. D. The requirement to follow the insurance company's directives. The correct answer, B. The obligation to provide accurate and complete information. Explanation. Mr. Wilson is obligated to provide the client with accurate and complete information to make an informed decision. By failing to explain the potential consequences of surrendering the policy, Mr. Wilson violates this ethical principle. Question 89. Ms. Lee, an insurance broker in Oregon, encounters a client who is unable to afford the recommended insurance policy. Instead of exploring alternative options, Ms. Lee pressures the client into purchasing the policy beyond their financial means. What ethical concern does this situation raise? A. Ms. Lee's failure to maximize her earnings. B. The potential harm to the client's financial well-being. C. The necessity for the client to prioritize insurance coverage. D. The requirement for Ms. Lee to adhere to company policies. The correct answer, B. The potential harm to the client's financial well-being. Explanation. Ms. Lee's actions may harm the client's financial well-being by pressuring them into purchasing a policy beyond their means. Ethically, Ms. Lee should prioritize the client's financial interests and explore alternative options that align with their budget. Question 90. Mr. Martinez, an insurance producer in Oregon, learns about a new insurance product that offers unique benefits to clients. However, the product is associated with higher premiums. What should Mr. Martinez consider when recommending this product to clients? A. Emphasizing the benefits of the product to justify the higher premiums. B. Prioritizing his personal preference for the product. C. Disclosing both the benefits and drawbacks of the product to clients. D. Concealing the drawbacks of the product to encourage sales. The correct answer: C. Disclosing both the benefits and drawbacks of the product to clients. Explanation: Mr. Martinez should provide clients with a comprehensive understanding of the product, including both its benefits and drawbacks. This allows clients to make informed decisions based on their individual needs and circumstances, aligning with ethical standards of transparency and honesty. Question 91. What is one of the primary reasons insurance companies conduct underwriting investigations before issuing policies? A. To increase administrative overhead. B. To identify potential fraudulent applications. C. To delay the issuance of policies. D. To expedite the application process. The correct answer: B. To identify potential fraudulent applications. Explanation: Insurance companies conduct underwriting investigations to assess the risk associated with insuring an individual and to detect any fraudulent information provided in the application. These investigations help prevent insurance fraud by ensuring that policies are issued only to eligible applicants. Question 92. Which of the following is an example of insurance fraud? A. An insured individual intentionally misrepresenting their health condition on a claim form. B. An insurance agent providing accurate information to clients. C. An insurance company processing claims promptly. D. An insured individual paying premiums on time. The correct answer: A. An insured individual intentionally misrepresenting their health condition on a claim form. Explanation: Insurance fraud occurs when an individual intentionally provides false or misleading information to an insurance company for financial gain. This can include misrepresenting health conditions, falsifying claim documents, or staging accidents. Question 93. What role do insurance fraud investigation units play in preventing and detecting insurance fraud? A. They encourage fraudulent behavior among policyholders. B. They identify legitimate claims for payment. C. They conduct investigations to uncover fraudulent activities. D. They expedite the claims process to minimize fraud risk. The correct answer: C. They conduct investigations to uncover fraudulent activities. Explanation: Insurance fraud investigation units are responsible for investigating suspicious claims and activities to identify instances of insurance fraud. By conducting thorough investigations and collaborating with law enforcement agencies, these units play a crucial role in preventing and detecting fraudulent behavior within the insurance industry. Question 94. What is a red flag that may indicate potential insurance fraud during the underwriting process? A. A policyholder providing accurate and verifiable information. B. Inconsistencies or discrepancies in the applicant's information. C. A policyholder disclosing all relevant details without hesitation. D. The applicant's willingness to pay higher premiums. The correct answer: B. Inconsistencies or discrepancies in the applicant's information. Explanation: Inconsistencies or discrepancies in the applicant's information, such as variations in reported income or conflicting medical history, may raise red flags for potential insurance fraud. Insurance companies carefully scrutinize such discrepancies during the underwriting process to prevent fraudulent applications from being approved. Question 95. What measures can insurance companies implement to prevent insurance fraud in claims processing? A. Streamlining the claims review process. B. Conducting thorough claims investigations. C. Automatically approving all claims submitted. D. Avoiding communication with policyholders. The correct answer: B. Conducting thorough claims investigations. Explanation. Insurance companies can prevent insurance fraud in claims processing by conducting thorough investigations into suspicious claims. This may involve verifying the details provided, gathering additional evidence, and collaborating with fraud detection units to identify potential fraudulent activities. Question 96. How can insurance agents contribute to preventing insurance fraud? A. By encouraging clients to submit inflated claims. B. By educating clients about insurance fraud risks and prevention measures. C. By collaborating with clients to fabricate insurance applications. D. By avoiding reporting suspicious activities to insurance companies. The correct answer, B. By educating clients about insurance fraud risks and prevention measures. Explanation. Insurance agents play a vital role in preventing insurance fraud by educating clients about the risks associated with fraudulent activities and providing guidance on how to avoid becoming victims or perpetrators of fraud. By promoting awareness and transparency, agents help maintain the integrity of the insurance industry. Question 97. How can insurance companies utilize data analytics to detect potential insurance fraud? A. By ignoring patterns in claims data. B. By analyzing claim patterns and identifying anomalies. C. By minimizing data collection efforts. D. By restricting access to claims data. The correct answer, B. By analyzing claim patterns and identifying anomalies. Explanation. Insurance companies can leverage data analytics to detect potential insurance fraud by analyzing claim patterns and identifying anomalies or irregularities in the data. By detecting unusual patterns of behavior, insurers can flag suspicious claims for further investigation. Question 98. What role do state insurance departments play in combating insurance fraud? A. They encourage fraudulent behavior among insurers. B. They provide resources and support for fraud prevention efforts. C. They minimize regulatory oversight. D. They expedite the approval process for fraudulent claims. The correct answer, B. They provide resources and support for fraud prevention efforts. Explanation. State insurance departments play a crucial role in combating insurance fraud by providing resources, support, and regulatory oversight for fraud prevention efforts. They may conduct investigations, issue regulations, and collaborate with law enforcement agencies to prosecute fraudulent activities. Question 99. How can policyholders contribute to preventing insurance fraud? A. By providing false information on insurance applications. B. By inflating the value of their insurance claims. C. By reporting suspected fraudulent activities to the insurance company. D. By withholding relevant information from insurance agents. The correct answer, C. By reporting suspected fraudulent activities to the insurance company. Explanation. Policyholders can contribute to preventing insurance fraud by reporting suspected fraudulent activities to their insurance company. By promptly reporting any suspicious behavior or fraudulent claims, policyholders help insurers identify and investigate potential fraud, ultimately protecting the integrity of the insurance system. Question 100. Under Oregon insurance regulations, what is the primary purpose of reviewing insurance forms before they are issued to policyholders? A. To ensure that insurance agents receive adequate training. B. To guarantee that insurance companies maintain high profitability. C. To protect policyholders from unfair or deceptive insurance practices. D. To expedite the claims process for insurance companies. The correct answer, C. To protect policyholders from unfair or deceptive insurance practices. Explanation. The primary purpose of reviewing insurance forms before issuance in Oregon is to protect policyholders from unfair or deceptive insurance practices. By scrutinizing insurance forms, regulators aim to ensure that policy terms are clear, accurate, and not unfairly discriminatory, thus safeguarding consumers' interests. Question 101. What entity in Oregon is responsible for regulating insurance rates to ensure they are fair and reasonable? A. Oregon Department of Transportation, ODOT. B. Oregon Health Authority, OHA. C. Oregon Insurance Division, OID. D. Oregon Department of Environmental Quality, DEQ. The correct answer, C. Oregon Insurance Division, OID. Explanation. The Oregon Insurance Division, OID, is responsible for regulating insurance rates in the state to ensure they are fair and reasonable. OID reviews rate filings from insurance companies to evaluate whether the proposed rates comply with state laws and are not excessive, inadequate, or unfairly discriminatory. Question 102. What action can the Oregon Insurance Division take if it determines that an insurance rate is excessive, inadequate, or unfairly discriminatory? A. It can impose fines on policyholders. B. It can immediately approve the rate filing. C. It can disapprove the rate filing or require modifications. D. It can ignore the rate filing and take no action. The correct answer, C. It can disapprove the rate filing or require modifications. Explanation. If the Oregon Insurance Division determines that an insurance rate is excessive, inadequate, or unfairly discriminatory, it can disapprove the rate filing or require modifications. This ensures that policyholders are not subjected to rates that are unjustified or discriminatory, promoting fairness and consumer protection in the insurance market. Question 103. What is the purpose of rate regulation in the insurance industry, as overseen by the Oregon Insurance Division? A. To maximize profits for insurance companies. B. To ensure affordability and accessibility of insurance coverage. C. To discourage competition among insurance carriers. D. To restrict policyholder access to insurance products. The correct answer, B. To ensure affordability and accessibility of insurance coverage. Explanation. Rate regulation overseen by the Oregon Insurance Division aims to ensure the affordability and accessibility of insurance coverage for consumers. By preventing excessive rates and unfair practices, regulators help maintain a competitive market while protecting policyholders from financial burdens. Question 104. How does the Oregon Insurance Division typically review insurance forms submitted by insurance companies? A. By accepting all forms without scrutiny. B. By conducting a cursory review of selected forms. C. By conducting a thorough review of all forms. D. By delegating the review process to insurance agents. The correct answer, C. By conducting a thorough review of all forms. Explanation. The Oregon Insurance Division typically conducts a thorough review of all insurance forms submitted by insurance companies. This process ensures that policy terms are clear, accurate, and compliant with state regulations, ultimately protecting consumers from deceptive or unfair practices. Question 105. In Oregon, what is the purpose of regulating insurance rates and forms? A. To increase administrative burdens for insurance companies. B. To limit consumer choices in the insurance market. C. To promote transparency, fairness, and consumer protection. D. To encourage insurance fraud and abuse. The correct answer, C. To promote transparency, fairness, and consumer protection. Explanation. Regulating insurance rates and forms in Oregon serves to promote transparency, fairness, and consumer protection within the insurance market. By ensuring that rates are reasonable and forms are clear and accurate, regulators help maintain the integrity of the insurance industry and safeguard the interests of policyholders. Question 106. What role do insurance rating organizations play in the regulation of insurance rates in Oregon? A. They have no involvement in rate regulation. B. They set mandatory rates for all insurance companies. C. They provide advisory services and data used in rate filings. D. They enforce compliance with rate regulations through audits. The correct answer, C. They provide advisory services and data used in rate filings. Explanation. Insurance rating organizations in Oregon provide advisory services and data that insurance companies use in rate filings. These organizations collect and analyze data on insurance risks, helping insurers establish appropriate rates while ensuring compliance with regulatory requirements. Question 107. How does Oregon ensure that insurance forms comply with state laws and regulations? A. By allowing insurance companies to self-certify their forms. B. By conducting periodic audits of insurance forms. C. By requiring insurance companies to obtain approval before using forms. D. By delegating form review to independent contractors. The correct answer, C. By requiring insurance companies to obtain approval before using forms. Explanation. Oregon ensures that insurance forms comply with state laws and regulations by requiring insurance companies to obtain approval before using them. This process allows regulators to assess the fairness, clarity, and compliance of insurance forms to protect consumers' interests. Question 108. What is the primary goal of rate regulation in Oregon's insurance market? A. To stifle innovation and competition. B. To maximize profits for insurance companies. C. To ensure that insurance rates are fair and non-discriminatory. D. To limit access to insurance coverage for consumers. The correct answer, C. To ensure that insurance rates are fair and non-discriminatory. Explanation. The primary goal of rate regulation in Oregon's insurance market is to ensure that insurance rates are fair, reasonable, and non-discriminatory. Regulators aim to balance the interests of insurers and consumers by preventing excessive rates while maintaining a competitive and accessible insurance market. Question 109. What is the primary responsibility of the Oregon Department of Consumer and Business Services, DCBS, in regulating insurance? A. Setting insurance rates. B. Conducting insurance fraud investigations. C. Ensuring insurance solvency. D. Administering insurance exams. The correct answer, C. Ensuring insurance solvency. Explanation. The primary responsibility of the Oregon Department of Consumer and Business Services, DCBS, in regulating insurance is to ensure insurance solvency. This involves monitoring the financial health of insurance companies to protect policyholders and maintain stability in the insurance market. Question 110. What role does the Oregon Insurance Division play in insurance regulation? A. Enforcing traffic laws related to insurance. B. Licensing insurance agents and brokers. C. Regulating interstate insurance transactions. D. Administering Medicaid benefits. The correct answer, B. Licensing insurance agents and brokers. Explanation. The Oregon Insurance Division is responsible for licensing insurance agents and brokers within the state. This ensures that individuals selling insurance products meet certain qualifications and adhere to ethical standards, promoting consumer protection and confidence in the insurance industry. Question 111. How does the Oregon Insurance Division protect consumers in the insurance market? A. By setting insurance rates. B. By conducting market research. C. By investigating consumer complaints. D. By promoting insurance sales. The correct answer, C. By investigating consumer complaints. Explanation. The Oregon Insurance Division protects consumers in the insurance market by investigating consumer complaints against insurance companies or agents. This includes allegations of unfair claims practices, policy misrepresentations, or other violations of insurance laws and regulations. Through these investigations, the division seeks to resolve disputes and hold insurers accountable for their actions. Question 112. What is the primary function of the Oregon Insurance Division regarding insurance policy forms? A. Designing insurance policy forms. B. Approving insurance policy forms. C. Selling insurance policy forms. D. Marketing insurance policy forms. The correct answer, B. Approving insurance policy forms. Explanation. The primary function of the Oregon Insurance Division regarding insurance policy forms is to approve them. This ensures that insurance policy forms comply with state laws and regulations, provide adequate coverage to policyholders, and contain clear and understandable terms and conditions. Question 113. How does the Oregon Insurance Division contribute to consumer education in the insurance industry? A. By providing free insurance policies to consumers. B. By offering insurance agent training programs. C. By conducting consumer outreach and education initiatives. D. By sponsoring insurance advertising campaigns. The correct answer, C. By conducting consumer outreach and education initiatives. Explanation. The Oregon Insurance Division contributes to consumer education in the insurance industry by conducting consumer outreach and education initiatives. These initiatives may include distributing informational materials, hosting educational seminars, or providing online resources to help consumers make informed decisions about insurance products and understand their rights and responsibilities. Question 114. What authority does the Oregon Insurance Division have over insurance rates? A. Setting insurance rates. B. Negotiating insurance rates with insurers. C. Reviewing insurance rates for compliance. D. Implementing insurance rate discounts. The correct answer, C. Reviewing insurance rates for compliance. Explanation. The Oregon Insurance Division has the authority to review insurance rates for compliance with state laws and regulations. While it does not set insurance rates directly, it ensures that rates charged by insurance companies are fair, actuarially sound, and not discriminatory. This helps protect consumers from excessive or unjustified insurance rate increases. Question 115. What is the primary role of the Oregon Insurance Division in regulating insurance companies? A. Marketing insurance products. B. Reviewing insurance claims. C. Licensing insurance agents. D. Ensuring financial solvency. The correct answer, D. Ensuring financial solvency. Explanation. The primary role of the Oregon Insurance Division in regulating insurance companies is to ensure their financial solvency. This involves monitoring insurers' financial activities, such as their reserves and investments, to ensure they have sufficient funds to pay policyholder claims and obligations. Question 116. How does the Oregon Insurance Division protect consumers from unfair insurance practices? A. By setting insurance premiums. B. By regulating insurance policy terms. C. By conducting market research. D. By enforcing insurance laws and regulations. The correct answer, D. By enforcing insurance laws and regulations. Explanation. The Oregon Insurance Division protects consumers from unfair insurance practices by enforcing insurance laws and regulations. This includes investigating consumer complaints, conducting market conduct examinations of insurers, and taking enforcement actions against entities found to be engaging in unfair or deceptive practices. Question 117. What role does the Oregon Insurance Division play in overseeing insurance producer licensing? A. Issuing insurance policies. B. Collecting insurance premiums. C. Regulating insurance advertising. D. Licensing insurance producers. The correct answer, D. Licensing insurance producers. Explanation. The Oregon Insurance Division oversees insurance producer licensing by ensuring that individuals and entities selling insurance products in the state are properly licensed. This helps protect consumers by ensuring that insurance producers meet minimum competency and ethical standards and comply with state laws and regulations. Question 118. What is the minimum age requirement for obtaining an insurance producer license in Oregon? A. 18 years. B. 21 years. C. 25 years. D. 30 years. The correct answer, A. 18 years. Explanation. In Oregon, individuals must be at least 18 years old to obtain an insurance producer license. This requirement ensures that applicants have reached the legal age of majority and are considered responsible adults eligible to enter into contracts. Question 119. How often must insurance agents in Oregon complete continuing education (CE) requirements to maintain their license? A. Every 2 years. B. Every 3 years. C. Every 5 years. D. Every 10 years. The correct answer, A. Every 2 years. Explanation. Insurance agents in Oregon are required to complete continuing education (CE) requirements every 2 years to maintain their license. CE courses help agents stay updated on industry trends, regulations, and best practices, ensuring they provide accurate and ethical service to clients. Question 120. Which of the following is not a subject area covered in the mandatory continuing education (CE) courses for insurance agents in Oregon? A. Insurance ethics. B. Industry marketing techniques. C. Oregon insurance laws and regulations. D. Product-specific training for insurance policies. The correct answer, B. Industry marketing techniques. Explanation. While insurance agents may receive training on marketing techniques as part of their professional development, it is not typically a subject covered in mandatory continuing education (CE) courses for insurance agents in Oregon. Instead, CE courses focus on topics such as insurance ethics, state-specific laws and regulations, and product-specific training to ensure agents have the knowledge and skills necessary to serve clients effectively and ethically.